I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to Equity Mates Investing, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. I'm very excited for this episode. We are about to speak to the Dean of Valuation.
Yeah.
It is something that we all are trying to get our heads around. I think conceptually it's probably the hardest part of investing, trying to put precise values on an imprecise future for a lot of these companies. Certainly something that I am trying to work on, become better at valuing companies. And there is no one in the world, literally no one in the world, better to speak to about valuation than this expert.
That's right. Today, we are very excited to be joined by Aswath Damodaran. He's a professor of finance at the Stern School of Business at New York University and is known in the finance industry as the Dean of Valuation.
Yeah, I'm pumped for this one. We're going to talk about, how he introduces his students to valuation, some of the key concepts that he has popularized or introduced and written about. And then we're going to talk about markets today. And of course, we're going to ask about the valuations of the Magnificent Seven, the big US tech stocks. Yes. So I'm looking forward to hearing which one of those is still cheap. Now, before we get to it, we do need to remind everyone.
This is not financial advice.
That's right. This podcast is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general. With that said, let's take a quick break and then get to our conversation with Aswath Damodaran.
Equity Mates, we are super excited to announce that we're back with live events in 2024, and the first one is kicking off on the 10th of April with a live Ask an Advisor.
That's right. We are going to be joined by Glenn Hare of Fox & Hare. He is one of Australia's best financial advisors, and it's going to be your chance to ask your money and investing questions.
That's it. So join us. Head to equitymates.com/events for more information and to secure your tickets. They're going to sell fast. We cannot wait to see you there. Aswath, welcome to Equity Mates.
Thank you for having me.
So when you have a new cohort of students at NYU, where do you start conceptually when you're teaching them about valuation?
I start with the basics. I try to explain to them that they already understand the basics. All I can do is provide a structure to what common sense would give them. I mean, if you strip it down, there is no theory in valuation. It's the simplest of all exercises. To put a number on something, you can do one of two things. You can estimate the cash flows you will get from owning the business, or you can look at what other people are paying for similar businesses. That's it. Now, we can add layers of detail to it, but I start there and then I say, look, I know for the moment you're saying, how do I come up with these cash flows and how do I adjust for risk and time? But those are details. It's really that big picture perspective that guides us all the way through the class. So start with basics and then build up.
You make it sound so simple, but it's certainly the hardest part of investing, I think. And
No, I think you're mistaking life for investing. Life is hard. Forecasting the future is hard, right? Now, what I'm trying to say is the mechanics of investing are easy. What people run into is predicting, forecasting the future, and they assume that that's because they don't know valuation. You sit down to value NVIDIA. Your biggest challenge is not that you don't know how to estimate cash flows or discount rates. That's easy enough to do. None of us knows how AI will play out and what it will show up as NVIDIA selling more AI chips. So we need to separate out how much of this is you're not understanding valuation and how much of this is you not wanting to grapple with the fact that the future is uncertain and more uncertain in some businesses than others. And that's going to show up in your valuation.
Yeah, I like that. That might be the title of the episode. Investing is easy, life is hard. So when it comes to this valuation work, there's a few concepts that have become synonymous with your work and that you've written books on and spent a lot of time on, and would love you to explain them and help us understand them. And when we were preparing for this interview, we thought the right starting point for this was understanding the difference between price and value.
I ask people to think about how much they pay for an apartment or a house they bought recently. And for many Americans, that's getting out of reach. But when you think about how much you pay for a house or apartment, you don't do an intrinsic valuation. You basically decide how much to pay based on what other people are paying for similar houses. That's pricing. You're essentially looking at what other people are paying. And in a way, most of our lives is spent by looking at what crowds do. I mean, I don't know about you, but I decide what to watch on Netflix by checking out Rotten Tomatoes. I decide where to eat by checking out Yelp. Think of markets as essentially the crowd judgment on what companies are worth, and you try to use that crowd judgment, and that's what pricing does. You're trusting the crowd on average to get it right. You're saying individually crowds might make mistakes on companies, but collectively they're usually right. In valuation, you approach it differently. You don't think about buying something because everybody else is buying it. You buy it because you're interested in it as a business. You're buying it as a business. And when you buy it as a business, I don't care what other people think about your business, that it's glorious or awful. Ultimately, it's cash in, cash out. You can't get away from that. So when you think about an asset as a business, you got to understand the business. You got to understand what drives its growth and its profitability and its risk and bring them all into an assessment of value. Now, we might call this a discounted cash flow valuation, but remember, valuation predates discounted cash flow valuation. Discounted cash flow valuation is a tool that has been developed primarily in the last 87 years. 1937, John Williams' book was the first one that described the mechanics of discounted cash flow valuation. But I think of intrinsic valuation as predating discounted cash flow valuation. The Venetian glassmaker in the 1500s who decided how much to pay for a business based it on cash flows, growth, and risk. It's as old as time. But it is more work because you have to understand the business to be able to value it. So given a choice in valuing something and pricing something, most people, including most people who claim to do valuation, are really doing pricing.
And I've read some of your writings about how people will claim they're doing valuation work when they do, look at price to earnings or look at price to earnings relative to other peers in their field. But that's not really valuation work. That's a pricing exercise.
But you know why they do it? Because we've trained people to believe that pricing is shallow and valuation is deep. That we all want to be Warren Buffett. We don't want to be somebody who picks stocks based on what other people are paying. So they get that message, which is even if you're doing pricing, you got to masquerade as if you're doing valuation. And this is especially true if you're a professional money manager. Right? You have to create that facade of, I think about cash flows, growth, and risk, when all you're thinking about is momentum, mood, and what's everybody else buying. Now, I tell people, look, if we could all be better investors, we were all more honest with ourselves about what we're doing. There is nothing worse in investing than to trade and act like you're an investor, or vice versa, invest and adopt trading. Trading is what pricers do. Investing is what people who use value do. There's nothing better or worse about one versus the other. But most people who claim to be investors are really trading. They buy low, sell high. And there's nothing wrong with it. That's effectively just as good a way to make money as investing. It's just a different way.
Now, related to this concept of price and value is numbers and narrative, and you literally wrote the book on this. So I guess, can you talk us through numbers and narrative and I guess how they fit together when you're doing a valuation exercise?
I can tell you where that book was born. It was born from looking at a couple of things out there that seem to be in direct contradiction of each other. Here's the first. We have far more data today than we did 40 years ago when we sit down to value companies. I'm old enough to remember using an annual report, a physical annual report, and doing a valuation with a pencil on a ledger sheet, right? Minimal tools, very little data.
Yeah.
We have far more data than we ever did, and we have far more powerful models than we ever did. And here was the contradiction. I was noticing that the quality of valuations was actually getting worse rather than better because you'd think that with all this data, all these tools, you'd be getting more sophisticated, better valuations. So I started thinking about why is that happening? And the more I thought about it, the more I realized that people are not valuing companies anymore. They're doing financial modeling. To them, valuation is an Excel spreadsheet. You change the numbers, you project the numbers out, you use some neat little functions, you build some macros, maybe even bring Python into the mix. It's become the mechanics of the process, and people have lost sight of the fact that the numbers are essentially a reflection of a story you're telling about a business. And because it's so easy to grind out the numbers, 40 years ago, you had no choice but to tell the story because your numbers were limited. You had to tell people, this is why I think Coca-Cola is a great company going into the 1980s. It's a US company that's poised to go globally, and therefore I think it is going to grow faster. And because it spun off its bottlers, it doesn't make the actual product, its margins can be high. And then you put the numbers on paper because there weren't that many numbers. Today, what do you have? You have a 20-year projection of growth and margins, and people have forgotten that those numbers don't come out of nowhere. Every number tells a story, whether you want to or not. In fact, one of the exercises I do in my class, I give them an Excel spreadsheet, a banking valuation. Banking valuations are not valuations, they're just financial models. I give them the spreadsheet and say, tell me what the implicit story is in these numbers and tell me whether you think a company like the one described in this model can actually exist. So the narrative in numbers was really about filling in that space where people had lost connection to the numbers. The models were running analysts rather than the other way around.
Yeah, I love that. And we certainly see, I think you use the example in your book about a company like Uber, which, was reaching billions of dollars in valuation without, making a profit. And you sort of see how valuation is often driven by narrative. And I guess, the AI boom that we're living through now.
I mean, let me back that up. It's not that valuations are driven by narrative. It depends on where you catch a company. Uber in 2013, there was not much history. There wasn't really a company. It was all potential. Your entire value comes from the story. There are no numbers. So you're going to look at historical numbers and try to project them. God help you, there aren't any.
Yeah.
In contrast, if you ask me to value Coca-Cola today, I could do a valuation entirely with the numbers. Now, the way I describe it is when you're valuing a young company, it's like being called in to finish a book where the authors died and they want you to complete the book. So the young company, you're called in chapter 2 of the book saying, you know what, there are 33 more chapters in the book, can you complete the book? And guess what? The range of stories you can tell is huge because the story is still getting formed. In contrast, if I call you in chapter 33 of a 35 chapter book, you don't have much room to run. So when you value Coca-Cola, there aren't that many divergent stories you can tell about where Coca-Cola is going. Its story has been pretty much told. In contrast, if we're valuing Palantir, think of the range of stories. Or even NVIDIA, which is a little further advanced than Palantir, but still it's all about the future. The more value comes from what you will do in the future, the more stories matter. The more you can just grind out old numbers, you can get away with doing it. I mean, let's face it, Australian, Canadian companies, I don't value very many because most of them are incredibly boring. The stories told, right? You take BHP. Where are you going to go with this story, right? We can talk about how climate change can be an existential crisis to your story. And that actually is something interesting because you can't just project out. The way people used to value commodity companies was take the pricing cycle, average it out, and normalize the price, right? Oil price will always return to $51 a barrel. We'll value it on that basis. That works if your cycle reverts back to the way it used to be. And the way I think about valuing oil companies today is with climate change and the threat, the potential that fossil fuels will become a smaller part of our energy requirements. When I value an oil company, I can't just assume reversion to the past, normalization. That has to now become part of my story, which means the more you think fossil fuels will be curtailed, the less likely you will be to buy ExxonMobil. And that's the way stories go. Your story is going to drive your valuation, and I think we need to make it more explicit.
Yeah. So now I guess we want to get to some of the different levers of valuation. You write about the 4 levers of valuation being revenue growth, operating margins, reinvestment, and then risk. So can you talk us through how those 4 elements come together?
I'm actually going to step back from the actual metric. Okay? Growth is obviously the first one. Why am I looking at revenue growth as opposed to earnings growth? Because The only measure of growth that actually captures true growth is revenue growth. You can grow your earnings as a mature company by cutting costs. So I want to get a sense of how big is your market, how much are you growing. So revenue growth becomes my proxy for the growth in your business. My second measure is profitability. I'd like you to be in a profitable business. The way I'm going to measure profitability is with operating margins, not net margins. Because again, you can take a profitable business, if you borrow enough money, make its net margins low. So I want to look at the operating profitability of your business. The third is the dark side of growth. I mean, if you ask companies, do you want to grow a lot or not grow at all? Every company is going to say, I want to grow a lot. You're an airline. You want to grow a lot. What do you have to do? You got to spend a ton of money. In fact, I don't think it makes sense for you to grow because by the time you're done, what you've spent, you're never going to get back. So the reinvestment is really the sobering side of growth. It's what I used to tell managers, hey, you want to grow, but are you willing to reinvest this much? Because this might mean you'll never pay a dividend. You might have to issue fresh equity. If they say, look, I don't want to do that, then I say, you got to go back and look at your growth story because you need reinvestment and growth to be consistent. The story you're saying has to be the same. As for risk, I think in finance, we've made the mistake of making it a number, a metric, a beta, a cost. Ultimately, risk, there's two components of risk that show up in evaluation. One is your operating risk as a company. The ups and downs that come from being a cyclical commodity company, a company that sells discretionary products. That's what we capture in our discount rate, operating risk. But there's another risk we don't even talk about, partly because it makes us uncomfortable, which is the risk you will not make it. 2/3 of startups don't make it. If you ask me to value a startup, I need to bring that in explicitly. You'd be surprised. Venture capitalists don't do this. I think that venture capitalists try to push this all into a target rate. I want to make a 50% return when in fact the bulk of the risk you're worrying about is, will this business make it? So I'll divide risk into two components, an operating risk that shows up in the discount rate and a truncation risk, which can come from, it can come from distress that you will not make it, you run out of cash. Just last week I wrote a piece on catastrophe risk, and it was precipitated by an email I got from a reader in Iceland who said, I'm looking at this company called Blue Lagoon. It's an Icelandic spa, a very profitable, established spa, but it's right below a volcano that's erupting in Iceland right now. And the lava is moving down. And there's a chance, a real chance, not just tiny chance, that this spa will not just be threatened, but wiped out. He said, how do I bring that into valuation? You can't do it by raising the discount rate. This is an existential risk. The way you have to bring it in is you have to assess the likelihood that the volcano will continue to erupt, the likelihood that the lava will flow in the direction. You're saying, how the heck am I going to do that? There's no way around it, right? Uncertainty is uncertainty. This is part of what I said. People think that valuation can solve the problems of life. I can't build an Excel spreadsheet that removes the risk of a volcanic eruption. All I can do is be realistic about assessing it. So think about risk on both levels, operating risk and truncation risk. And those are the components that drive value. A discounted cash flow value is just a vehicle for bringing all of those things together into one. So when I look at a discounted cash flow valuation, I don't see cash flows and discount rates. I see a story about growth and margins and reinvestment and risk. And the question I'm asking is, am I okay with the story?
So conceptually, we're covering off a number of the building blocks here. Understanding the difference between price and value, understand what you're doing, and then understanding the roles that numbers and narratives play in evaluation. Then some of the key levers of valuation that we've just covered off. And then finally, we thought an important concept to cover off is the probabilistic margin of safety. Now, Bryce and I are both big fans of Seth Klarman's book, Margin of Safety. It's probably one of my favorite investing books. And you've taken that concept and then added your own twist to that with the probabilistic margin of safety. So can you tell us about that?
See, to me, it doesn't show up as a margin of safety. It shows up as an expected value. Let's say I value the Blue Lagoon at $1 billion without the volcanic eruption. Let's say there's a 30% chance that the volcanic eruption will deliver lava in my way. And remember, it's too late to go out and try to buy insurance now, right? Maybe 20 years ago you could have, but there's no insurance company in the world that's going to sell you insurance against an eruption that's already in place. So if this eruption happens and 30% of chance of lava coming down, the value of Blue Lagoon is going to be zero, right? It's not even that you can sell the land. What are you going to sell? The lava is going to have a life of several years before it cools down. You can do anything. So I've got a discounted cash flow valuation of the going concern of $1 billion, the 70% chance of that happening, and a value of zero, the 30% chance. When I'm done, I have an expected value of 700 million. There's no margin of safety needed on this. It's already incorporated. So when people talk about margin of safety, I love Seth's work. Remember, it's a post-valuation component you bring in because you think you could be wrong on your assessment of value. This has nothing to do with risk or cash flows. So this has nothing to do with the company. This has to do with you, which is if you're risk averse, you value the company, say, I don't know whether I got that right. One of the ways you try to deal with that is by saying, I could be wrong, so I'm going to need the value to be at least 30% higher. But be careful. If you do that, I don't know whether you remember in statistics, there are two types of errors you can make, type 1 errors and type 2 errors. So if you convert that to valuation, by putting a large margin of safety, what are you doing? You're avoiding buying something that's overvalued simply because you screwed up in the value. So you're avoiding type 1 errors, but you're creating type 2 errors, which is you're also avoiding buying things that are undervalued because you put a margin of safety. Which is going to be greater? It depends. I would argue that in the world we live in, you can't afford to have a margin of safety. If you have a margin of safety, you're going to be all cash. In fact, one of the questions I ask people, they say, I have a big margin of safety, is I ask them, what percentage of your portfolio is in cash? And they say 60%. And my response is, your margin of safety is too high. If you have that much cash, you essentially don't have the luxury to turn away investments. Maybe in Seth's time, he had hundreds of potential investments that were cheap and he could pick only 20. You can afford to have a margin of safety. No. But beggars can't be choosers. We are in a world where it's tough to impose a large margin of safety and get away. And there's a flip side of that. I recently bought Tesla at the time that the price approached value. People were surprised. They said, it's a risky company. And if it's just fairly valued, why would you buy it? Because I think there is the flip side of margin of safety, which is what I call optionality. What's the optionality with you do a valuation of a company, you base it on what you think the company can do with its existing assets and business model. What you're missing is whether that business model gives you a launching pad to do other things in the future. I bought Facebook when it got close to fairly valued. Again, the reason is you have a platform with 3 billion people. My valuation was built on advertising revenues, but if you have 3 billion people spending an hour every day on your platform, think of the other stuff you might be able to do with them. That's like icing on the cake. So when I buy at fair value, if they can pull off any of that stuff, it's added value to me. So I would actually flip this on its head. There are some companies we actually should be buying as soon as the price hits the value, because there's so much good stuff you haven't built into your intrinsic valuation.
Yeah, I love that. Yeah.
So Aswath, before we move on to getting your views on markets today, there are a lot of people in the Equity Mates community who have just started their investing journey. And Alec and I remember back when we first kicked off, there was this feeling that, you wanted to be the next Warren Buffett, and the whole aim of the game was to find undervalued hidden gems that we really had no idea what we were doing. So for all of those people that are in the first month or year of their investing journey and just looking to build a portfolio that grows wealth over a long period of time, practically, how should they be thinking about valuation in their investing journey?
I think first you need to be realistic. Investing is about preserving and growing wealth. It's not about getting rich. In fact, if you define investing as I want to get rich, you are going to crash and burn because you're going to overreach. You're going to concentrate your portfolios. You're going to make bigger bets than you should. So here's the bad news in investing. To invest, you need wealth. To get wealth, you got to do something. So if you're a doctor, spend your time as a good doctor. Don't spend the middle of your day checking out the stock pages because you think you can get rich that way. Earn an income as a doctor and use investing as a way of preserving and growing wealth. So I tell people who are not in the investment community, there's nothing wrong with being interested in markets, but you need to earn to be able to invest. You have to make sure you're not putting your earning power at risk because you're so fascinated by that next big hit you can get. Second, think incrementally, right? I mean, Warren Buffett didn't sit down in 1956 and say, I want to be a 40 billionaire. He built up. And along the way, he was good, but he also got lucky, right? He's open about admitting the fact that he hit the market at a time where it was easy to find undervalued companies because people were not digging very deep. I'm not sure that if he started in today's market and today's age, he would be able to pull it off. In fact, his advice to investors is put your money in an index fund, go back to living the rest of your life, which is actually awfully good advice for most people in investing. More time and energy and resources is wasted chasing beating the market than any other activity. So if you enjoy, so first, don't invest if you don't enjoy the process of investing. Don't invest because you expect to get rewarded. This is a game where you can do everything right and have nothing to show for it. I give people a very simple test. I say, let's say you are an active investor. You go try to find these undervalued companies. You do this year after year. You read Ben Graham's security analysis. You read every one of Warren Buffett's letters to his shareholders. You're immersed in value investing, and every year you go do your homework. You pick companies. I say, let's say you're at the age of 85. You're lying on your deathbed. And I'm a very cruel person. I show up at your deathbed with your investment track record for the last 60 years, with all the work you put in. And a competing portfolio, what would have happened if you'd just taken your money at the age of 25, put in an index fund, and left it there? The question I ask people is, would you be okay if the index fund beat you? If the answer is no, don't be an active investor. Because here's what happens. People are active investors because they think they're doing the right thing. And then they think they're entitled to earn a higher return than their neighbors who are picking stocks based on watching Jim Cramer on CNBC or reading the stars or whatever. And then they discover that their neighbor bought NVIDIA by accident 4 years ago and is rich, and they're not. And that's when bad things start to happen, because you get frustrated, you get angry at markets, and then you double down. The key to remember in investing is if things don't go against you, they don't. I mean, there are too many things you don't control. You have to be okay doing everything right and not getting a reward, but you're okay with it because you enjoy the process. So one of the questions I'd ask them is, while you're listening to these shows and reading all these stuff, are you really enjoying yourself? And I enjoy looking at companies. I enjoy the business, and this is part of my life. I have to teach about these companies, but I enjoy it as a person. So to me, even if I broke even with the market, I'm okay with it because I enjoyed myself along the way. The advice that follows then is, don't do things then that can create serious damage. Now, it's like the Hippocratic Oath, do no harm. Like what? Don't put all your money in 4 stocks. Why? Because you think you can get rich with 4? Because that is the pathway where you take an action, you spend all these resources, and you can end up with half the wealth of your neighbor. And that's not a good place to be. So don't overdo it. Just take it a step at a time. Enjoy the process. And if you find yourself not enjoying the process, step away. There are far better ways to live your life than chasing after stocks and getting frustrated. Because it doesn't work for most people who claim to be professional investors. Why do you think it should work for you?
Love that. Well, Aswath, we're going to turn to markets today, but before we do, we're just going to take a very quick break. We'll be right back. Welcome back to Equity Mates Investing. We're joined by the Dean of Valuation, Aswath Damodaran. Now, Aswath, let's move to today's market. And I want to chat about the Magnificent Seven, because they're certainly capturing investors' attention, capturing headlines. But the question always turns to valuation for these ultra mega caps. So how are you thinking about the current valuations of some of these big tech stocks? And I guess the follow-on, are you actually seeing any opportunity based on valuation in the Magnificent Seven?
Let me start with the bad news. I wouldn't buy any of the 7 at today's stock prices. They're fully valued. But at the same time, that doesn't mean much, right? I mean, the people then extrapolate from there and say, I've lost my chance. I'll never be able to own these 7 companies. That's not the case. I own all 7, but I didn't buy them last year. I bought NVIDIA in 2018. I bought Microsoft after its catastrophic metaverse meltdown. I bought Apple after an iPhone upgrade didn't work out. I bought Microsoft when a new CEO came and looked like they were heading to the creeks in terms of they had my Office and Windows and nothing else. And so what the point I'm making is these are great companies. They're amazing business machines, and they're a reflection of what I call the winner-take-all economics of the 21st century, which is every business we look at, you're going to see one or two companies dominating because of the way we're delivering that business. I give the example of advertising. If you went back 20 or 30 years and you looked at advertising market shares, you'd see companies like the New York Times. Big market share, 3%, 4%. That was a big market share. Why? Because you were localized, you were a newspaper, you could do only so much. You could not sell the bulk of India because they didn't even read English. Today, if you look at advertising, 60% of advertising is online advertising. And if you look at online advertising as a business, two companies dominate, Google and Facebook. Everybody else is a bystander. 70% of the growth in online advertising over the last decade has gone to these two companies. And it's not because they're breaking the rules or violating antitrust laws, it's the economics of the business. When you advertise online, you want to go where everybody else is. You don't want to go to some niche platform. You want to go where hundreds of millions of people gather. So guess what? Google search and Facebook are where you go. So as businesses become more and more winner take all, you're going to see more of this phenomenon, a few companies gaining at the expense of the vast majority of smaller or mid-sized companies. Does this mean you should just buy big companies? No, that's not going to work either. If you pick the winners, of course it's going to pay off. But ahead of the fact, you don't know who the winners will be. So I would keep a list of companies that are dominating their businesses and wait for the right time. And there will be a right time. Because the nature of these companies is expectation. I mean, think of NVIDIA. People think that Jensen Huang walks on air. I mean, he is at this moment, NVIDIA is considered the greatest company of all time. That's a dangerous place to be if you're management of the company, right? Because the expectations are you're a genius. You'll figure out how to deliver 50% growth from now through eternity with 60% margins. You can't do that. There will be disappointments. So if you lost the NVIDIA bandwagon, you never got on it, and you say, oh my God, that was an opportunity gone by, bide your time. It will be cheap again, but it will mean that you got to track the company, you got to value the company, you got to understand the company. And it can't be based on what other people are doing. You'll actually be buying when they're selling. When everybody's panicked. I mean, I remember when I bought, Facebook, I still call it Facebook, Metaverse after the fiasco. People said, what are you doing? Nobody likes the company. I said, but it's got an advertising juggernaut that's going to deliver tens of billions of dollars in cash flows. Why do I care that people don't understand or don't like the company? I'm going to get the cash flows. And you can tell me whatever you want about privacy or whatever other issues you have with Facebook, but as long as people show up on the platform and the advertising is there, I get my value. And so I think that part of being an investor as opposed to a trader is having a sense of what you'd like to do and biding your time. Time is your ally here. I mean, I remember Buffett saying, it's like he used the baseball analogy. He said it's like being a hitter in baseball, but you can never strike out. In baseball, 3 strikes, you're out. So basically, hitters have to swing with 2 strikes, otherwise they strike out. But if you can never strike out, you just stand there and stand there and stand there and wait for your pitch to come. But that takes patience.
One thing that I've certainly learned, so this is our 7th year of doing the podcast, and we weren't really investing before that. When I would read an answer like that or hear an answer like that, I would often think patience requires me to wait, decades perhaps for the right time to buy a company. But even in just the 7 years we've been doing this podcast, some of those big tech companies have had multiple points where they've been good buying opportunities. Facebook, to take an example, they fell out of love after the 2016 election because of all the political stuff, and then 2020 the COVID dip, and then 2022, 2023 the metaverse stuff. There's been multiple instances even in the last 5 or 6 years. So it's a reminder that you've got to be patient, but it's sometimes there's more opportunities than you might think hearing that answer.
In fact, I'll generalize on that. There isn't a single stock that stayed overvalued through its entire life, ever.
Yeah,
No,
that's
I can't think of a single one. I valued Amazon every year since 1997. And we're picking the very top end of stocks now, right? You pick the Amazons, you think the Googles, you think the Facebooks, the big winners. And each of those stocks had multiple points, not just one point, multiple points at which you could have bought those stocks. I mean, I bought Amazon 5 times in the last 26 years. I've sold it 4 times in the last 26 years. Why one less? Because I'm owning it right now. But that's because I track the company, I have my story for the company, I have my investment and valuation for the company, and the market does whatever it does. It's not in my control. And that's why I tell people, don't get frustrated with what the market is doing. It's going to do what it does. And it's in fact because the market is so volatile and unpredictable that you're going to get your chances. So while you complain about it doing crazy things on NVIDIA on the upside, prepare for it to do crazy things on the downside, and there's your chance.
Yeah.
So I know it's difficult to be patient. And that's why I said you got to start by accepting that investing is about preserving and growing your wealth. Because the minute you say it's about getting rich, you can tell me as much as you want that you're going to be patient, but you will not be, right? Because you need to get there in a hurry. You need to pick the next winner. You put the weight of the world on your shoulders. And when you do that, you're going to make some bad choices because you're essentially treating the market as the equivalent of a casino. You got to hit that number or it's not going to pay off.
So we've just spoken about the Magnificent Seven, which is capturing everyone's attention at the moment, it seems. So let's turn away from that. Is there any part of the market that you believe people aren't paying enough attention to that perhaps you're looking at and getting excited about, but you think the rest of the market hasn't caught up with you?
I think every part of the market has a clientele, people who pay. And I look at utilities. You say nobody pays. There are actually people who live in that space. That's all they do. In fact, the problem here is people get tunnel vision because they get so focused on a segment of the market. And then they, come to believe that the rest of the world is unfair to that segment, whether it's real estate or utilities or energy. And I think that's dangerous. I think one of the things we need to do is step back and gain perspective. Look at the broad market. And right now, the broad market is priced well. It's not overly, rich. In fact, I compute an equity risk premium for the entire market. But much of that pricing is coming from this top tier of companies. If you remove them from the mix, the market actually looks much more modestly priced. The big companies, and because of the market cap, they have a disproportionate weight, are carrying the market to heights. But I think the rest of the market, if you break it down, is reflecting very much what you'd expect to see in a world with 4% interest rates and growth that looks reasonably good now that people are not as worried about recession.
On the macro side of things, you can't make a finance podcast in 2024 without talking about inflation and interest rates. So we'll ask that customary question. And I guess in particular for the context of our conversation around valuation, how do you factor in the conversation around inflation, interest rates, and I guess monetary policy into your thinking around valuation?
I try not to, because in a sense, there's nothing I can do about it. And I think, again, investing in valuation, we spend so much time worrying about things. I call it taking the karmic pose. There are things you don't control in investing. Worrying about them is not going to make them go away. It is true inflation has been a clear and present player in this game for the last 3 years. And the reason it's so shocking for people is we spent a decade with low and stable inflation. If you look at the history of inflation in the last 200 years, the last 10 years were the aberration. So rather than think about these as being abnormal times, maybe we need to recognize that the last decade leading in were the abnormal times. We're reverting back to a more normal time. But since we're spoiled, we're lazy, we're sloppy because of that decade, it's taking us a while to catch up. So we're in better shape with inflation than we were a year ago. But the problem with inflation is it's incredibly stubborn. It's very difficult. I called it a genie in the bottle in 2021 when I wrote about it. I said, look, There's a genie in the bottle, it wants to get out. So even if you think inflation is transitory, treat it as permanent, fix it quickly, because once you let it out of the bottle, getting it back in is going to be difficult. But at that time, the Fed didn't want to do anything. They talked about this being supply chains and COVID, and then it was too late. Inflation was out of the bottle. I think at this stage, it's still out of the bottle. It's maybe halfway squeezed in, but it can change its mind.
Well, Aswath, it's been a really enjoyable conversation. Before we close out, if there's one company that's really exciting you from a valuation point of view at the moment, or the story that's unfolding, what would that be?
I mean, how can it not be NVIDIA, right? Because it's become a microcosm for how the world will change over the next decade, right? I think people are overreacting in terms of giving it almost all of the pluses that come out of the AI business. The fact that, I mean, it makes the way to think about NVIDIA is the way I thought about Cisco during the dot-com boom. It provided the architecture that allowed us to all to connect online. Now, it will happen in the background, right? None of us went on Cisco.com. We went on AOL.com or Amazon.com, but all those sites rested on an architecture that was built with Cisco networking equipment. If you think about NVIDIA, none of us is going to use, very few of us are going to use NVIDIA products directly. There might be an NVIDIA chip in your Mac or your computer, but the reality is you're not even aware of it. But it is providing the architecture for everybody else to do their stuff. So in a sense, it is going to be the entree into how big is this going to get, who's going to use it. And while I don't like the way people are pushing up the pricing and assuming that all of the spoils are going to go to NVIDIA, I think as a company, it's going to become this just as Amazon.com became the poster child for the .com market. NVIDIA could very well become the poster child for how big is this business getting, how well are they doing, who's using these chips.
Love it.
Yeah,
Well,
we'll be watching.
Yes, we'll be watching. Well, Aswath, thank you so much for your time this morning. Truly have really enjoyed this conversation. I'm sure many people in the Equity Mates community have taken a lot of value from this as well. So, yeah, we really appreciate you taking the time.
You're welcome.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.